Last week, the annual meeting, formerly known as the Jackson Hole Economic Symposium, took place. The meeting's been going for the last 30 years or so, and every year in late August, the Kansas City Fed becomes home to central bankers, economists, policymakers, and academics from all over the world. Amongst others in attendance this year were Fed Chief Janet Yellen and the Governor of the Bank of Japan, Haruhiko Kuroda. Despite the international attendee list, most market watchers were much more focused on the US domestic scene, it seems, and just trying to garner from Yellen's speech some idea of when and if there'll be another interest rate rise in the US this year. The media's reporting gave a sense that an interest rate hike is near, and the debate seemed to be around whether it would be September or December. But financial markets were less convinced. Futures trading suggesting a likely outcome being a quarter-point rate increase in December, but only pricing in less than a 50% probability of this taking place. US equity markets the same. They finished down on the day and have remained around those levels, so perhaps investors factor in a greater likelihood of a rise. The utilities sector took the biggest hit on that day and has fallen further subsequently. But the sector had already begun declining from July. It had been on a very strong run from the start of the year, up around 18% to mid-year, making it the best performing sector in the S&P 500. It had been driven higher by the search for yield, but perhaps valuations had become too stretched already. US jobs data released today, just an hour or so ago, were meant to strengthen the case for the rate rise. However, the non-farm payrolls came in at about 151,000 jobs last month, well below the consensus expectation of 180,000 and close to our economist Bob Johnston's estimate. So perhaps the media has been a little bit too optimistic on the prospects for a rate rise this year.